to sell you anything. Nothing I say here constitutes financial advice whatsoever. What I'm seeking to do is give you good knowledge of the current structures of what is available through pensions, and in particular sort of touching on the tax reliefs that make them so attractive in the first place. But with all my webinars, I always like to start with a bit of a history lesson to work out how we ended up with such incredibly complex pension legislation and why it is such a hot political potato. So pensions, I was doing a bit of research on this last night, and the earliest date I could find which was relevant to sort of current rules actually goes back incredibly to 1859. 1859 was when the civil service first introduced what is now known as final salary schemes. Prior to that, what had happened in essence was, if you had a good job in the civil service, you would effectively sell your employment to some underling, and they would pay you either a lump sum or an annual payment of some sort, which was, if you like, the birthplace of pensions. But the civil service got their act together in 1859, and they set up a non-contributory scheme which effectively paid out a pension once you reached age 60 based on the number of years that you worked and 1/60th of your salary for each year that you worked. And unbelievably, those rules that were put in place in 1859 are still in place today in a lot of final salary schemes. Not that there's too many of those left, but that's really where it comes from. You have to bear in mind, at the time, 1859, the average life expectancy was under age 60. So it wasn't too much for a stretch of them at that time. And really over the next, sort of, going into the early 1900s, is really when private companies got on board and started setting up pensions for their employees at that time. And I think it was Coleman's in Norwich were the first company actually to set up a pension trust where they actually separated assets away from main company assets. So that sort of brings you up to the 1900s. In 1908, the Old Age Pensions Act was introduced, and that paid out a pension of a whopping 10p per week to those who are aged 70 or over, and also of good character. So it wasn't universal at that point. You had to have good character to get your old age pension. And then nothing much happened really until 1921, 100 years ago. So we should be celebrating this anniversary. Is when tax relief on pensions was actually first introduced. So for the first 60 or so years, there was no relief for the companies or tax relief on individual contributions. That came in 1921. Then we sort of whistle forward to around about 1946 is when they introduced national insurance, and the concept of a pension for everybody was born based on contributions. Then nothing much really happened until around about 78, which is when they introduced SERPs, as the state earnings related pension scheme. It's like a top-up pension based on your earnings. And then the biggest change, I think, comes in 1988, when, following the Financial Services Act, which came in 86, they introduced the concept of personal pensions. It's the first time at which pensions effectively became individual. And there was a big rush in the market to move into that type of scheme. Then in 95, some pretty serious legislation came in the Pensions Act, which was all centred around the regulation of pensions, which I'm not saying it was quite the Wild West at that time, but people like Bob Maxwell and others managed to steal hundreds of millions from people's pension schemes, and regulation was clearly needed and brought in at that time. And a lot of those rules are still in place effectively. Fast forward to 2001, there's a bit of a failure, this one. That's when they introduced so-called stakeholder pensions. The idea was that these were the cheap things aimed at low-earning employees and women in particular to save for their retirement, but it was never really taken up in numbers at all, and pretty much doesn't exist now. And then we go forward to probably the second biggest change, 2006, which became known as A Day, there was a significant rewriting of the rules and the introduction of effectively a lifetime allowance, and also some changes in the manner in which you could draw your pension. Up until that point, anyone who reached 75 had to buy an annuity with whatever was in their fund, and that restriction was removed at that point, which fundamentally changed the way pensions were viewed, I think, by most people. More forward to 2012, we get auto enrollment. At that point, what's the reason for doing that? Well over half of the population in 2012 had no form of pension savings whatsoever. Staggering figures, really. And the idea was obviously to move everyone into a situation where they could fund for their own retirement. Obviously, having the option to opt out hasn't completely done that, but it has brought an extra 10 million people into pension savings. So you'd have to say it's been reasonably successful. If you fast forward all the way to the present time, there's 2015, another major change in pensions. It's known as Freedom Day. We'll cover that later in the seminar. Again, more freedom in the way people deal with their pensions, complete different set of rules yet again, and complications that go with that. Why is this such a political thing? And it comes up in every budget. They're going to cut tax relief on pensions in one way or another. Well, the cost of pension tax relief in the UK, based on the 2017-18 figures that the Revenue released, was a staggering £37.2 billion. And that is effectively lost corporation tax on corporate contributions, lost income tax on tax relief that individual contributions have made, and of course the cost or the lost revenue, if you like, on the investment income that actually arises within those pension funds themselves, because they all operate on a tax-free basis. So that's really the sort of the key dates. And as I say, the one I'll cover most is the 2015 changes, which we'll come on to. One of the other areas we hear this all the time is lost pensions, and the figures again here are quite staggering. I don't know what you're like, but if I lose a fiver out of my back pocket or a couple of quid down the sofa, I spend a fair amount of time looking for that. But you'll be surprised how many people come in and sit in front of us and say, "Oh yeah, no, I had this pension with this job I worked at like 20 years ago. There's nothing in it." Yeah, well, there's 1.6 million people like that. The current estimate of unclaimed pension funds is a staggering £19.4 billion. Just sitting there for someone to find their old pension scheme. On average, it's around about £12,500 per pot. As I say, 1.6 million unclaimed pension funds. And it is so easy to find them now. The government put up the site on Gov.uk where you can effectively put in your employment history, and it will pull up all of its knowledge regarding that company's pension schemes, and effectively provides you with a tracing service free of charge that normally comes back within sort of 4 to 6 weeks from our experience. Just to give you a real life example of that, one of our advisors was speaking to a client who had moved jobs quite significantly in their early career. Every 2 or 3 years they had a different employer, and they were aware that they definitely had 4 pensions out there. Didn't know what they were, and we had to use the system to trace them and find them. But in actual fact, when it came back, there were 6, not 4 pots, and an extra 15 to 20,000 of funds was actually found for that client just by using this tracing service. Just a word of caution: if you go on Google and put in pension tracing service, the gov.uk hit comes around about number 4 or 5. I think there's about 3 or 4 above that. And they all say things like free tracing service, and when you look at it, it's perhaps not quite as free as it looks. So just be careful that you're clicking on the right links. But it is certainly, if you're not aware of where all of your funds are, or you know someone who's not aware of where all of their funds are, it's very worthwhile using this service and checking what the system is on that particular pension. Okay, so that's the history and finding your old stuff. What can you do today, the current pension choices? In essence, I mean, I simplified this massively, but in essence, there are two different ways these can be looked at the moment. You've got personal pensions, so these are pensions typically funded by self-employed, and they're set up either as a straightforward personal pension. They go and see an advisor. The advisor says you pay this much per month, and it goes into a fund, and that builds up a pot. They're fairly popular. SIPs are probably slightly more popular for the self-employed. It stands for self-invested personal pension. I'm sure you'll be familiar with these. In essence, it gives you a lot of control and more choice as to how your funds are actually invested. You still need a professional trustee, and a professional trustee will certainly still be advising you and hoping that you don't lose all of your money, but it gives you a lot more individual freedom if you want to take some of those investment decisions yourself, and we'll come on to what they might be in a moment. I put up there the concept of partnership SIPs, which is technically not really a concept at all, but typically this might be people working together in some sort of professional practice, and maybe they want to make a joint investment of some sort. That might be property or something similar. In actual fact, they will all have individual SIPs, but generally under the same trustee management that effectively groups them together as a group. And then we have company pensions, of course. So these will apply to people that are employed or the senior directors, etc., of a private company. Generally speaking, these days, and again, I am summarising here, but generally speaking, most company schemes set up for employees are in effect group personal pensions, in the sense that any contributions that go in for an individual are earmarked for that individual only, and they're not affected by other employees in the scheme, but it's grouped together effectively for administration purposes, and there might be one advisor that speaks to the employees individually. What we see with a lot of our clients, are schemes called Ssas, or small self-administered scheme. These are certainly very popular for entrepreneurial types who want to take more control of their pension scheme. You can have up to 11 members, but quite typically we'll see perhaps 3 or 4, maybe the 2 main directors and spouses in a scheme. And effectively, I think perhaps maybe a little bit misunderstood, is you are taking on, if you set up the Ssas, effective trustee responsibility. And it's something that has to be stressed, because whereas on a SIP you have a professional trustee looking after the administration and making sure you comply with all of the pension codes, when it comes to a Ssas, that really is down to the individual members to make sure they are complying with all of the legislation and not falling foul of any of the rules. And falling foul of pension rules can be an expensive situation. In terms of, just to give you some numbers on like how it is now, final salary schemes, which as we worked out, go back to 1859. In the heyday, there was probably 18 or so million people who were members of final salary schemes of various sorts over the years. There's only actually now 1,000 active schemes left in the UK, as most employers have moved away from them because they're just too expensive. And the number of employees in them is about 3.7 million now, and it's falling at a rate of 300,000 to 400,000 a year. So it won't be too long before the final salary schemes effectively come to a complete end, I should think. So that's the current pension choices, i.e. the type of pension scheme that you can have. But what about what can you put into it? And this is where, again, there's been a huge amount of change over the years. Back on the figures this morning, and since 2006 alone, there's been 10 major changes, both in the lifetime allowance and also the annual allowance relevant to the legislation. So to be clear, the lifetime allowance, that is the amount that you may fund your pension to, effectively. See it as a target, if you like. When it was first introduced, which was part of the A-Day legislation, the lifetime allowance was set initially at £1.5 million, which sounds like a decent sum, and it was scheduled to increase, not quite with inflation, but over a period of years, which it did up until 2012, when it hit its high of 1.8 million. So you could fund effectively into your pension to build up a fund of 1.8 million and still get the benefits of all of the tax-free, no capital gains tax, no income tax within a pension fund, of course. But then we got to 2012. The cost of pension tax relief in the UK, as I say, it's 37 billion, was scheduled to go even higher than that. And they started tinkering. I say tinkering, really, they took an axe to the lifetime allowance, and it fell from 2012 at 1.8 million down to 1.5 in 2013, down to 1.25 in 2015, and then down to 1 million flat in 2017. At that point, they said, okay, the million, we're not going to mess with it anymore. We'll increase it each year in line with inflation, so that give everyone certainty. And that did happen for a couple of years, and the lifetime allowance went up to 1,073,100, which is a nice easy number to remember. And then COVID happened, and obviously we're short of a few bob in the exchequer at the moment. This was one of the easy things to hit. The increase, the effective inflationary increase in that allowance has effectively been frozen. Currently, we are told it is frozen to 2026, which is a pretty significant factor. If you think of what inflation might be by 2026, it's probably the equivalent of about a 15% cut in real terms, I would say. But at least we know what the lifetime allowance is now, and we know what it will be to 2026. Beyond that, in theory, it should start to creep up again in line with inflation. But who knows? Who knows? There's been so many changes in pension rules. It's difficult ever to look too far ahead with certainty and say, well, that's absolutely going to be the case. But certainly there are no political parties looking to change the current rules. I think, to be honest, everyone's more concerned about COVID than tinkering with pensions at the moment. But that's where we are now. So lifetime allowance, and that's an individual allowance, of course. So in a married couple situation or unmarried couple situation, two people together could effectively fund 2.15 million into a pension fund and still meet all of the tax-free criteria. So that's a lifetime allowance. That's what you can fund to, but what can you fund each year, i.e. how much can you contribute? And here there's been even more changes and more draconian cuts over the last couple of years. When A-Day, the 2006 rules came in and they brought in the lifetime allowance, at that time they set the maximum contribution per year that you could make at 215,000, which is a staggeringly high figure. But that's what it was. That actually went up slightly over the couple of years that they increased also the lifetime allowance to 255,000, and then dramatically in 2011 it went from 255,000 to 50 overnight. So the amount you could contribute into your pension scheme was suddenly cut from a significantly large figure down to a more modest 50,000. In 2014 they went further and they cut that down to 40,000. And that 40,000 limit is still the case today, albeit there are further cuts, because in 2016, the 40,000 on its own was considered too generous for those who earn too much, effectively, and they introduced, if you like, an income limit. And if your income limit was over a certain amount, which originally was 150,000, you were restricted in making contributions down to 10,000 in 2016. In actual fact, it's gone a little bit further since then. So the current rules, depending on your income level, but if your income level is above 312,000, you're actually restricted down to £4,000. And there is a taper between the 4 and the 40 that is in theory available to everyone, depending on your earnings. So pretty significant restrictions on what you can actually put into it for high earners, and it actually leads, in a lot of cases, especially for directors of private companies, becomes a tax planning issue, where you've got the ability perhaps to vary your income levels because you're in control of your own remuneration or dividends or whatever it is, that you are able to do that and gain effectively extra allowance into your pension scheme. So that's the annual allowance, say typically 40,000, but it can be restricted as low as 4,000. Your lifetime allowance currently 1,073,100. Always like to think of that as double it up for yourself and significant other, and think about it in that respect. So that's what you can put into it. Investment opportunities. This is where I'm straying slightly into areas that I shouldn't be. It's on the next slide, Charlotte. So typically, an all moment here is demonstrating the type of areas that people might invest in. I'm not advising you to go one way or another, because that would constitute financial advice, and that's something that has to be done on an individual basis. But to give you the broad view of the typical things that we see, by far, most people have their pension just simply invested in what's known as managed funds. So your advisor would sit down with you, they'd talk about your risk profile, all that sort of stuff, and they'd recommend suitable funds for you, and you're reliant on the fund managers to hopefully get you a decent return over a period of time. Depending on age profile and all the rest of it, sometimes you're getting closer to the retirement age, or when you might want to draw from your pension. Corporate bonds or gilts are seen as a more secure asset, are less risky in terms of stock market movement, and your risk, if you like, is more centered around interest rates, which seems to be quite easy to predict at the moment because they're just very, very low forever, it would seem, at the moment. Commercial properties is the next biggest one, and a lot of our clients are certainly involved in this area, and that's buying commercial property using either a Ssas or a SIP of some sort, sometimes banded together with colleagues or co-directors, etc. And when you're buying property within a pension scheme, effectively it can amount to extraction of funds without any actual cash movement, because typically we've seen situations where property might be actually owned in the company itself, and we remove it from the company into the pension scheme, so it continues to benefit from tax-free growth. There's no actual cash movement there, but you still get tax relief on that contribution effectively coming into the fund. And of course, you can also go out and you can borrow commercially on property purchases, subject to a limit of what assets you actually have in the scheme. Typically, you're restricted to borrowing on 50% of the value of your fund assets, but it can enable you to buy a bigger property than you actually have funds available in your pension scheme. Loans to your company through a Ssas is quite possible. In theory, you could also do this from a SIP, but trying to find a trustee that would actually do that is incredibly difficult. But via a Ssas you can, and again, you can lend effectively up to 50% of the value of the assets in your fund back into your private company if you need that for cash flow purposes. Now, it's not quite as simple as some people would like it to be. You don't just write yourself a check and say, I'll pay it back sometime. There has to be security for the pension scheme over something. It might be stock, might be debtors or something like that, or property. And typically these loans run on a maximum of 5 years. It can be rolled over, but there has to be intention to repay to keep with all of the pension legislation. You will find some pension schemes that will also allow you to buy unquoted shares in private companies. But again, that becomes a difficult situation for trustees because the valuation of private companies is notoriously difficult, and justifying why you want to make that investment compared to everything else that's out there is something that can't be taken lightly, especially in a Ssas where you are responsible effectively as a trustee yourself. It's not just yourself you have to worry about. There's some, people say to us, well, I'm not going to sue myself, am I? No, you might not, but your dependents might. Your dependents, down the line, look at that and say, well, that money should not have been lost. They were badly advised. Who do I sue? So you have to take these rules seriously. And then there's other categories. You will find, if you Google, a whole host of strange investments that you can actually make via a pension scheme. We don't really get involved in these, but you can, in theory, have classic cars, fine wine, stamps. You can even have a zoo and an airport. I looked up, and these are available asset classes for you to invest in your pension scheme, although I'm not sure how you keep to the lifetime allowance and buy an airport in your pension scheme. But in theory, these are the sort of things. They have to be investments that are either intended to go up in value or produce an income of some sort. So those really are the main categories that you can invest into. Now we get on to the exciting stuff, which is the 2015 Freedom Day, as it was announced, and it came with much excitement from the government at the time. And you may recall there was a big fear that people would just simply take all their money and run and ruin their entire pension schemes. In essence, what was the change? Well, the change was massive, actually, because up until 2015, there was restrictions on what you could take from your pension scheme on an annual basis. There are no restrictions after April 2015. You can build up a pension fund, and let's say it's £1,073,100, and you get to the first date that you can take it, which is currently 55, and you can say, I like it all, please. I don't want an income, I want to spend the lot. And you're quite entitled to do that, subject, of course, to a little bit of tax. So this is how it works. Anything you take, 25% of your fund can be on a tax-free cash basis. That's fairly common. That's been in the legislation for some considerable time. What used to happen was then you take an income or even buy an annuity back in the day, and you'd have an income each year on which you're taxed as normal income. And that is still the case. It's just that you can take a whole lot if you really want to. So if you wanted to take 700,000 out, you can take 700,000 out, but you have to pay income tax in that year on the full amount. Okay. I was speaking to one of our advisors the other day. I was struggling to find a good reason why anyone would ever want to do that. I can't imagine why people would want to do that, but there was a lot of concern at the time. People would raid their pension funds on day one and go and buy Ferraris or yachts or whatever it was, and then they'd have no money to live on. That hasn't really happened. What did happen to some extent, I think those people who had relatively modest funds, probably up to a fund of say 30, 40,000, were taking the whole lot in one hit because it was never going to provide them with much of an income anyway. But once you get into larger fund values, you find that people tend to be sensible. But the flexibility is there to take income or not take income as you see fit. You can take 1% from your fund, you can take 10% from your fund. You can time it in terms of taking income out of your fund according to your other tax circumstances in a particular year. So a great amount of flexibility is now available, and it sort of takes away one of the major blockages that some people had in their mind of funding a pension, that they're putting this money away and they could never effectively get their hands on it in the future. Well, that isn't the case anymore. So that is the significant change. I can't see how they can take this back now. It seems to be one of those rules that's introduced that is a one-way system. But we'll see. We've said many times we can't see any further changes in pensions, and then they introduce a whole bunch of new rules. At the same time, there was a change in the minimum age. The minimum age for taking your private pensions is currently 55. That goes up to 57 from 2028, and thereafter it links to the state pension age minus 10 effectively. So as the state pension age increases from 68 through to 70, which I think is scheduled for around about 2040 something, then that will creep up as well, but it'll always be 10 years under the state pension age. Moving on to the next slide, this is where you realise just how different the rules are between the pre-6th of April 2015 and the post-6th of April 2015. And these are perhaps of more interest to your dependents than they are to you, but they are significant. So prior to the rule change in 2015, in essence, when you got to age 75, there was a significant change in what happens with your fund. But the rules are now very clear. If you happen to die before age 75 and you have money left in your pension fund, which hopefully you will have, the entire sum can go to your dependents on a tax-free basis. You can be as a lump sum, or you can take an income. It makes no difference, but it is entirely tax-free after that period of time. And there is also one of the other huge benefits of pension schemes. There is no inheritance tax at all. So no income tax, no inheritance tax. You funded your pension. You're unfortunate enough to not live to age 75. At least you have the certainty that that fund is going to your dependents on an entirely tax-free basis. If you live to 75, obviously I hope you all do, then the rules do change slightly, but they're still significantly better than they were. There used to be a 55% tax charge effectively. Now that has changed to effectively become an income tax charge on the recipients as and when they take it. It says on the slide there, lump sum payment subject to 45% tax. That's just the top rate of income tax. Could be less than that, depending on how much you got in the fund and what period of time that you actually take it over as well. The only other charge that you need to concern yourself with is what happens if you exceed the lifetime allowance. So you've funded your pension scheme well. You were targeting the lifetime allowance, but the fund's done so well that in actual fact you've ended up with more money in your pension scheme than the lifetime allowance at that time. In that scenario, what happens pre-75? Quite simply, the lifetime allowance passes on a tax-free basis, and there's a tax charge on the excess. That tax charge is still 55%. I'll come back to it. It sounds horrific, but I'll come back to why it's not quite as horrific as you think in a moment. But let's say you had 1.2 million in the fund, 100 that goes tax free, and there would be a 55% tax charge on the excess. If you're age 75 and over, again, similar sort of thing, but slightly different in the sense that to the extent that you exceed it, it's 55% of the lump sum, but if part of it is taken as income, then it's 25% charge plus whatever your income tax rate is at that time. The 55% charge, I think it's one of these things, it depends how you view it. If you say, well, that's horrendous, 55% tax, that's more than income tax, why would I ever want to fund to that value? Well, just remember that the money you put into the pension scheme, you've had tax relief on. So if you're a 45% taxpayer and you've made contributions into the scheme and that's taken you over the limit, you can take the view, I think, reasonably that, well, actually, I had 45% tax relief going into it. Then add to that while the funds were within my pension scheme, I didn't pay a penny of tax on them. And then at the end, there's the 55% charge. So really, what is the true charge? You could argue that actually it's a 10% charge on the excess because you had tax relief up front, you didn't pay any tax while it was in there, and now you have the charge at the end. So I'm not saying that people should fund their pensions to deliberately exceed the lifetime allowance. What I am saying is don't worry about it for two reasons. One, if you do, it's because your fund's done well, so well done there. And secondly, the tax charge actually isn't, when you break it down, as significant as it sounds. Moving on to the next slide. This is what we hear all the time. I call this like the Anti-Pension Brigade, and I've seen many of these over my decades working in tax. And this is typically what they say. They say, I'm too old, or I'm too young. There's never a Goldilocks. There's no one just in the middle. I'm too old, I'm too young. No, you're not. My house is my pension. Number of times I've heard that. Well, all I would say to you, when you need some money, what are you going to do? Knock off a conservatory or something? It isn't your pension, it's your house that you live in. Yes, people do go through the process of downsizing and that can create a lump sum, but don't think of it that way. Your house isn't your pension, that's where you live. And the other one, it's not worth it. It's not worth it. It just isn't worth it. By the time, it's 30 years in the future, it's not worth it. So I put together one slide, which I hope dispels all of this. And this slide is not meant to give any views on investment returns in pensions. You'll see why when we go on to it. And all I've done here is demonstrate the difference in tax treatment. Okay. So hypothetically, if you put £5,000 a year into the bank, you're going to pay tax on that interest. Okay. If you put £5,000 a year into an ISA, you're not going to pay tax on any of the interest or investment return. But if you make a pension contribution and you're a 40% taxpayer, you're going to get, for the same money, 40% effectively funded by the government. Looking at each of the years, I've done years 1 to 10 and then I jumped to 20 to 30. I've actually used, even though it's complete garbage, I've used the same investment return for all three. Right? These figures are based on an increase of 4% each year, plus the additional 5,000 contribution each year. So if you can find me a bank where you can actually get 4% interest, I'd love to know. But just to demonstrate what the effect of the tax is, these are the figures. So if bank interest rates were 4%, if my ISA improved by 4% each year, and if my pension improved by 4% each year, these are the figures. And you'll see, putting money in the bank, 221,000, putting money in the pension, 486,000. If you put, and I didn't put it on the slide, but if you put, I don't know, 1% as the bank deposit rate in, that figure would come down to about 164,000, I think it was, which is 1/3 what it would be if you put exactly the same amount of money into a pension scheme at a 4% rate. In that scenario, you could take a 25% of your fund and have almost the same amount of money as if you just put it in the bank in the first place. So that's what we show to the Anti-Pension Brigade. If you go and see a financial advisor, they can't give you this slide because there's all sorts of restrictions on what they can say on investment returns and all the rest of it. This is purely to demonstrate the effect of the tax relief. Don't give it away. £37 billion is being used by the government to fund people who are actively making contributions into pension schemes. So if you come across people that are not one of those people, I almost want to thank them really, because they're paying more tax than they need to, so that I can have my pension tax relief. So there we go. I'm going to leave it with that example, and normally at this point we'll throw it open to questions. I would just say that if you've got any questions that stray into giving financial advice, we do have a couple of our advisors on, but we won't be able to answer those in open forum. But they're both available to take individual questions, and they can call you back straight after this. If you've got a general question about pensions, tax relief, etc., then we can certainly deal with those in this forum.
John, we had a question come through on the messages at 11:25, so sort of in the early stages of the slides.
Yeah.
So basically says, what were those figures again, re how much to put into a pension? And that was from Simon.
So let's just go back. That was, I think, slide 3 or 4, depending on which you count the first one or not. Yeah, that one. So the amount you can fund at the moment with full tax relief, the figure starts today at £40,000. That is the amount that you can fund. The only caveat to add to that is you must have relevant earnings to fund that amount, i.e. you must earn a salary or something like that. That 40,000, however, is tapered once you go above earnings of 240,000. And for each £2 you go above, you lose £1 effectively off that allowance. So once you get to 312,000, that's the maximum. Your contribution limit is restricted to £4,000. Anything below 240, you're at the 40. Anything between the 240 and the 312, you're on that taper.
John, can I just butt in here? And there are a couple of years you can go back as well.
Indeed, yes, there are. Yes.
Sorry.
That's all right.
Okay, so we've had another question in. Does the 40k limit include employer and employee contributions?
It does, yes. Yeah. So in a Ssas situation, that might be 100% employer contribution, but effectively it is a combined limit.
Do you have any more questions? Feel free to unmute yourself if you'd like to ask in person. Okay. Is the lifetime allowance the same as the value of all pension pots or just contributions?
It's the value of all of the pots. So the lifetime allowance is not that you can make contributions of 1,073,000. It is the fund values in total. So if you've got lots of different pension pots, you have to add them all up to work out whether you're still within that lifetime allowance. Any other takers?
Here we go. What did you mean by the terms crystallised and uncrystallised?
Very, very good question. So on that slide, that was what happens before and after the 2015 date, up to 75 uncrystallised, up to 75 crystallised. It simply means, have you taken income? So bear in mind that the difference in the rules really applied pre-2015. We don't have to concern ourselves too much with it, but in essence it was, if you've taken so much as £1 of income, that becomes a crystallised scheme. If you hadn't drawn anything from the pension at that point, then it's an uncrystallised scheme.
Okay, and another one, is there any advantage to a SIP over an SSAS?
SIP over a Ssas, that's a brilliant question. Advisors will probably talk about this all day long. Are there any advantages? The advantage, I think, is that you don't have to worry about the administration, the trustee responsibilities, etc. There isn't a huge amount of difference in what you can invest into, to be perfectly honest, but there is a big difference in the manner in which they are run. You can't just do what you want in a SIP without speaking to your professional trustee and making sure that he agrees with that. In theory, you could do with more flexibility what you wanted to do within a Ssas, but as I said, you are taking on that personal responsibility. You are acting effectively as a trustee, as a member of a Ssas. So that's probably the main difference.
Another point here is I have exceeded the 40k pot and have been offered scheme pays election.
I don't know the answer to that one. Eddie or Steve, are you there on that?
So is that scheme pension they're talking about?
Scheme pays election.
Yes, scheme pays election.
I've not heard of that term. I've heard of a scheme pension, an occupational scheme, but not scheme pays.
It's I'm just coming in here. It's part of the teacher's pension, so maybe it's,
right.
It's not in the real world. So
I can give you a little bit of input on that. So if you breach the annual allowance, there's an annual allowance tax charge. So with the changes in annual allowance, you might have heard of a lot of doctors and NHS pretty much, protesting on the changes. They were all caught up, the high earners, because the 40,000 allowance dropped to 10,000 at that point. That rule has changed now. So scheme pays essentially means if there's a tax charge to be paid, you can ask the final salary scheme to pay that tax charge on your behalf. That's all it is. So rather than you submitting a self-assessment and paying that tax charge through an accountant, you get the scheme to pay that tax charge.
And presumably that comes off your final pension.
Yeah, it does, and it's not a good idea to do if you can afford to pay it yourself.
Okay.
Yeah.
Thank you. Next question I have, which is a very insightful question. In your opinion, John, do the running costs have a significant impact on the returns? You gave me a 30-year example. Running costs obviously do have an effect. These days, the regulations are very, very tight in what financial advisors can say and demonstrate as potential returns, and all costs of running that scheme and annual charges, etc. There are limits on what can be charged. There certainly can't be any surprise charges anymore. They all have to be disclosed. I picked the 4% figure fairly deliberately because I think that's under what typically the market would have done over a 30-year period of time. Yes, it would clearly make a difference, but it is quite difficult to work that in, and that's why when I did that example, to make it not look quite so stark, is I put in the high rate of return on the bank deposit and in the ISA example, so that at least we're comparing the same rates. So all I'm demonstrating really there on that schedule is not I expect that to be the return, but I expect that differential always to be the case because of the tax charge and because of the tax relief that you're effectively gaining.
So we have two other messages for questions, and we also have someone who's raised their hand. So we'll deal with the messages that have come in first, and then we'll go to you, Simon, and you can ask your question. So the next question is, does the annual contribution amount to up to the total of earning, excluding dividends, include employer contribution as well as employee contribution?
So as I say, if I'm reading that, you're saying in terms of the 40,000 limit, do you need to have the relevant earnings, or the bit that the employer pays effectively is different to that? It's a complicated answer actually, because employer contributions effectively become a benefit or part of your package anyway. So there are some complex rules surrounding that. You have to look at each case individually. Unfortunately, I know that's not a great answer, but that's one we could pick up with you afterwards.
So another one is there any advantage in converting the old personal pensions plans to SIP? Particularly, is there any age limits by which you have to convert?
I'm not aware of there being any age limits by which you have to convert. Yeah, I think the answer is, it depends what you want to do. I mean, there's no point going into a SIP just for the sake of it. There has to be a purpose behind that. More relevant will be to look at what your current personal pensions are about in terms of what funds they're in, have they performed well compared to the market, etc. And look at it more generally like that. But if you were thinking, okay, well, I've got these funds and now I want to go and buy a commercial property, then that's a different scenario.
So
I'm not aware there's an age limit though. I don't know if Steve already can comment on that.
No, as a SIP is just a personal pension with an SI in front. It's the same rules as a personal pension. The age limits are exactly the same.
Okay, yeah, thank you.
The only point I'd like to add is I've come across quite this kind of scenarios or inquiries where clients are really sort of, keen on consolidation. Not always a good idea. I think it's very important to seek advice. A lot of older pensions had enhanced benefits attached to them. I've come across some which had 100% tax-free cash entitlement. So you want to make sure that you're not losing out by transferring it elsewhere. Although sometimes consolidation works well because it's easier to manage one scheme over 10 different pots.
Yeah.
So the gentleman that had his, oh sorry.
Yeah, go on. No, go on.
As I said, the gentleman that had his hand up, Simon, if he'd like to unmute to ask the question, or were you about to continue answering, John?
No, that's fine. That's fine.
Okay.
Thank you. Hi, John. Can you confirm the 30-year table that assumes compounded growth of what percentage?
I did it all at 4%.
Also, and again, I might have missed your view on this within the presentation. I have both an ISA and a SIP. And factoring in that you might get tax relief at the higher or the lower rate on the SIP versus no tax payable on the ISA, which one would you put money in first?
That's a great question. I think it depends on whether you've got funding for both. We are starting to stray into areas where you have to look at individual circumstances, but if you look at the basic math, the difference now, I think before 2015 I might have given a different answer, but you have the pension fund available for you to draw on. The reality is, however, we have lots of clients who build up very, very nice ISA nest eggs and pension pots alongside. It's rare that you need to spend all of the money at once. I'm not saying it doesn't happen, but it is rare. And most people, from whatever they've built up, whether it be ISAs or bank deposits or whatever it is, they effectively do pay themselves an income each year. They'll draw so much each year as whatever their income requirements are. So that's one of the factors you have to work out. What am I going to do? Do I actually need to cash it all in at one go at the end, compared to what restrictions there might be on the pension? But in terms of I want to take the whole lot, all of my cash as the ISA, I want to take all of my pension. You have the ability to do that now. So it does become a fairly simple maths equation. You have to look at what your tax rate is going to be at the time. There is a big differential between the 486 and the 291 on my crude example. If you were a top rate taxpayer and you took the whole lot in one hit, I think with the tax-free cash, it reduces you to around about 330, 340. So you're still slightly better off. But it does depend on how long you've been funding, the ISA compared to the pension, etc., and it does start to become a bit individual. So I think the tax relief can, if you're a higher rate taxpayer and getting the higher rate tax relief going into it, it can still be a better scenario. I wouldn't advise people not to do ISAs because there's room for both of these. And if you look at what you can fund combined into both an ISA and a pension, it's still, compared to a lot of people's earnings, not massively significant. So you can put 20,000 a year into an ISA, you can put 40,000 a year into pension. Well, if you've got 60,000 to spare, then do both. That would be the advice.
So effectively, you can go in during your working lifetime as a higher rate taxpayer, receive higher relief, but then when you come out the other side, when you're not perhaps earning your normal wage or your income, you can come out paying 20% of what you're taking out.
It's certainly possible, yes. And you know, the only caveat to all of that is, you know, what if the rules change, and that's you know, that's always going to be the case. But you know, it's difficult to see how the general principles of pension could ever really change. You know, there is tax relief going in, there's tax relief while you're in, there's going to be tax at the other end. I can't see them ever being exempted or anything like that. ISAs have been around for a very long period of time now, and again, I can't imagine any major changes in that respect. So we can almost rely on the concept remaining the same. But yeah, that's exactly the purpose of this Pension Freedom Day, is to allow people to plan for their best scenario at the other end. You know, you may have capital that you can live on and restrict your pension to the basic rate band. And there are people that do that.
So we have 3 more questions. So John, if you're in agreement, are you happy to take these final 3, and then perhaps if anyone else has any questions
how hard they are
after, then if they wanted to submit them, then
sure,
you know, you can have more individual chats, if that's okay. So if you exceed the 40k in one off year, does the prior year allowance automatically get allocated, or is there a form or return you need to complete to make sure you don't receive a tax charge in the year?
So why don't you answer that one, Steve, on the carry forward bit?
Yeah, if you go over 40,000 in this year, you can go back 3 years and you start to use up that allowance, which just makes sense, because if you don't use it next year, you're going to lose it. So you start with that. You have to notify your pension company that that's what you're doing. Normally we do that as advisors, we do it for you. I've not seen an accountant's form or an HMRC form that you do have to fill in. We normally tell that's in an application form, that's what we're using that allowance for. John, correct me if I'm wrong, I've not seen one from HMRC. If you've done one on
effectively you manage it yourself, normally in conjunction with your advisor. You don't want to go over the limit because there are excess charges that can apply. In theory, the revenue would pick this up. I don't know how long it would actually take them to pick it up, to be honest. Could easily be a couple of years, but we have on occasion had correspondence from the revenue when people have exceeded their annual allowances.
Can I just quickly add something?
Sure.
Just with the carry forward allowance from previous years, you must have relevant earnings in order to be able to carry that forward. So if you've got 40,000 a year income, you cannot put 50,000 into a pension and then expect that you can carry that 10 from previous year. It has to be equal to your relevant earnings.
Yeah, good point.
Okay, so the next question, if there are no special guarantees on annuities or tax-free percentage, etc., is it better to consolidate? Easy to manage, maybe overall charges may be lower?
I don't know. Do you want me to go with that one, John? I think when you look at consolidating any pensions, you've got to look at what you exactly want to achieve, what your goal is in 5, 10, 15, 20 years. But also what's really important now, and it's probably not convenient, is if you've got a pension that's only charging you 0.5% a year, why move it into a pension that's charging you 1.5% a year? And the funds are okay. So just by readjusting those funds in an existing pension scheme may be better for you for 5, 10, 15 years, etc. It's only when you come to retire and want to draw benefits that it may be beneficial for you to go into one pension pot, because you've got one income payment rather than 3, 4, 5, 6, whatever it is. And then it's going to be slightly more expensive because you go into drawdown and you get an advisor in tow. But leading up to that point, it may be just a question of readjusting funds, getting some more performance, rather than going through the expense of transferring.
Yep.
Okay, so yeah, the final question. If you use a SIP or Ssas to purchase a commercial property and say down the line the use of the building changes using the new permitted development rules to convert part of the building for residential use, then could there be any issues from HMRC? Thank you.
Short answer is yes. The longer answer, yeah, you cannot hold any residential property within the pension scheme, whether it be a Ssas or a SIP. It is a breach of the guidelines. So in that scenario, there would have to be an exit of that property from the pension scheme prior to any development actually taking place. Where you got the hazy line, if you like, is if you buy commercial property and then the value goes up because of permitted development, at that point it's still commercial property. You know, that's fine. You can sell the commercial property with that, in theory, enhanced value, and that's not a problem. But if you start to do the development yourself, that is a big problem. Anything else?
I think what I'll say is, obviously I have recorded this, so this afternoon we'll be sending you an email, obviously just to sort of thank you for attending, and there'll be there'll be a recording on there. So if you did want to watch anything back to any of these questions, then obviously feel free to. There will also be a link to a very short survey. It would be great if we can get your feedback as to how you feel everything went. So that would be great if you could do that. Our next webinar is actually going to be the autumn budget, and that's going to be a live Q&A on the day of the autumn budget release. So that's the 22nd and 27th of October. There will be a link as again on the e-shot we'll send to you. So if you'd like to register for that, then please feel free to. Other than that, thank you very much to John for presenting, and thank you everyone for attending.
Thank you.
Lovely. Thank you.